Hi, everyone. Welcome to CFMA's webinar series. Today, CFMA is pleased to partner with Associated Builders and Contractors in presenting Prevailing Wage Jobs, Competition and Compliance on Infrastructure Projects, which is sponsored by Procore. My name is Sue Mann, and I'm the Education Manager here at CFMA. Glad you decided to join us. Before we get started, I want to cover a couple things quickly. Today's webinar provides 1.5 CPE credits in the field of specialized knowledge. And in order to qualify, you'll need to respond to the alertness checks that appear on your screen. These monitor your attendance and are required by NASBA. A PDF of the presentation is located under the Resources tab, and a recording of this webinar will be made available in your CFMA account in about a day or two. If you'd like to send a question to one of the presenters, please submit one by clicking on the questions bar that's located underneath the chat, and the presenters have reserved some time at the end of the session to respond to questions. And now I'd like to take a moment to introduce our presenters. With us today is Adam Bonsky. He's President and CEO of ABC Insurance Trust, where he leads the organization in providing the employee benefits for members of ABC. Adam has more than 28 years of experience in the employee benefits, healthcare, and human capital management industries. He has held executive leadership and management roles in a variety of organizations. He was responsible for managing multiple insurance trust and retirement plan arrangements uniquely designed for construction and service contractors, and was instrumental in implementing those plans at ABC National. He's a graduate of Harvard University and lives in Austin, Texas with his family. Also with us is Nat Peniston. He's the Vice President of the Fringe Benefit Group, an industry leader in designing and administering benefits for hourly and part-time workers. Nat is a nationally recognized expert in employee benefits with more than 20 years of financial and insurance industry experience. He has authored numerous articles and books on employee benefits and best practices. He chairs the board for ABC's Central Texas chapter. He earned his bachelor's degree from the University of Miami and also lives in Austin, Texas. Welcome, Adam and Nat. And there's a lot of things to cover today, so I'm going to turn the program over to Adam.
All right. Thank you, Sue. And good afternoon, CFMA, I guess, except for those of you maybe in Hawaii or Alaska today. Thank you for that introduction, Sue. I'll just add that, for 11 of those 29 years in benefits, I worked at the contractors plan. And that is actually the time when Nat and I met. So Nat and I worked together for, I don't know, Nat, probably 8-9 years. And that's where I cut my teeth, if you will, on designing and building employee benefit programs specifically for construction contractors, and, got my deep learning in Davis-Bacon, Prevailing Wage, so on and so forth. So thanks for having us. Really appreciate it. So Nat, we're going to start with a brief commercial. I promise everybody that's on the call today, this will be very brief. I am the CEO of the ABC Insurance Trust. The trust was formed back in 1957 by ABC National. We work exclusively with ABC members in helping them design, implement, and manage their employee benefit programs. It's predominantly health-based that we help the members out with. We rely quite a bit on the contractor's plan for the retirement side of the solution. We are licensed in all 50 states and appointed by over 70 carriers nationwide. We have ABC member clients across the country, and we have several special programs that we offer to ABC members when they approach us. So with that brief commercial, I will pass it over to Nat to talk about the contractor's plan.
Thank you, Adam, and thank you, Sue, and good to be with everyone today. So the contractor's plan, if you're not familiar, we have been supporters of CFMA for many years, but we've been in business for close to 40 years now under the same family, so second generation. And I like to think of us as kind of the best of both worlds in terms of service and consultation and those types of things. We're small and family owned and a couple hundred employees. In terms of proprietary technology, in terms of the administration that we're providing, we're highly sophisticated, and we're working with over 200,000 employees, processing over 100 million in net revenue, which equates to premium equivalents of about $250 million each year. And the commonality across our firm is entirely around hourly workers. So we we work very closely with CFMA members, with ABC Insurance Trust members, with other associations, and we're entirely focused on prevailing wage and providing union-like benefits for non-union contractors. Obviously, if you're a union contractor, you're getting benefits from the union. If you're a non-union merit shop contractor, then you would work with a firm like ours to set those benefit programs up.
So I'll just add, there's a wide range of knowledge, of course, on today's call with respect to Davis-Bacon and state prevailing wage rules. So this is going to be fairly high level. We'll get into the weeds a little bit, but certainly if there's certain topics you want to get deeper into, please pop those into the question area, and we'll either take those questions here on the seminar, or we will make sure that all questions that don't get answered after this seminar webinar. What I would ask is that, try to take away at least 2 or 3 nuggets, if you will, at least a couple of things that you can take away and implement in your business. There's a lot to talk about with Davis-Bacon, but don't try to take on too much. If there's just 2 or 3 things you can take away to improve your business, then I think we've been successful today. So Nat, I think you're going to take the first slide for us, and then we'll trade slides back and forth from there.
Sure. So just a quick level set about prevailing wage, kind of what it is. A lot of people aren't familiar, and just it's fundamentally is a minimum wage law. It's a minimum wage law that applies to construction done by a government entity. Many of you might have heard of the Davis-Bacon Act. That's construction on behalf of the federal government. And then 26 states have their own state level prevailing wage. And then in addition to federal, state, there are also cities and counties that have their own prevailing wage requirements. So for instance, Colorado has no state prevailing wage, but the city and county of Denver do. Obviously, Davis-Bacon would apply to the state of Colorado on a federal level. So for instance, Denver International Airport's having a lot of construction right now. That would be prevailing wage under Davis-Bacon. The rest of the state, city or county or state project probably would not have prevailing wage, but city and county of Denver would have prevailing wage. So what is public work? I kind of just mentioned it, but it does vary based on the jurisdiction. In other words, who's setting the law, whether it's the federal government, whether it's a state or locality. And so those definitions change depending on that jurisdiction. For instance, Tennessee only applies prevailing wage to highway work. California applies prevailing wage to not only construction, but service and maintenance work. So if you're repairing an electrical panel for a state of California facility, that repair would be subject to state of California prevailing wage. Different jurisdictions also have different dollar thresholds of where prevailing wage kicks in. For instance, Davis-Bacon federal is $2,000. So if a project is $1,500, that would not be subject to Davis-Bacon, but a project that is, say, $5,000 or $5 million or $50 million would be subject to Davis-Bacon. State like Washington has no threshold. Every single dollar spent for the state of Washington on construction is subject to prevailing wage laws. And as you see there, California is 1,000, Maryland's $500,000. So again, it really varies by jurisdiction.
And now I'll just throw in one comment here about the part of Davis-Bacon where you'll see sometimes and related acts. Sometimes a contractor might get tripped up and not realizing that there's a Davis-Bacon related act that pulls a particular project under Davis-Bacon. And so, there are federal laws that authorize federal assistance for construction that come in the form of grants, loans, loan guarantees, and even insurance that's provided for by the federal government on a contract that pulls that project under the Davis-Bacon Act and its rules. So just something to keep in mind there, in addition to what Nat just said. Does that consistent?
That's an excellent point. Basically, anything that is getting federal money will likely be pulled into that. New York State, which has a very significant prevailing wage law. You might have read they're building a new stadium, and that new stadium that's going to cost, I think, about $500 million is going to be subject to prevailing wage, even though it's a private facility. It's receiving public dollars, and because it's receiving public dollars, it becomes subject to prevailing wage. So, excellent point. So one of the questions I get asked frequently is, how do I find the correct rate? Where do I go? And just because the wage determination, which is a fancy way of saying what a given occupation in a given area for a given stakeholder, like a state or a federal government, is, yeah, that's often published. And for instance, in California, you can go to the DIR, which is the Department of Industrial Relations website, and pull up what a master electrician in San Diego County would have for base wages and fringe benefits and these types of things. The problem with accessing that information is that it may or may not be in the bid or specifications or the actual contract. And so just because there is something called a laborer, and a laborer in a given area makes a certain base wage and a certain fringe, that if that's not in the contract, then that's null and void. You can't use that. And so a lot of people miss that. They also miss when that rate renews. And so again, it's very jurisdiction based. California, for instance, publishes a wage determination twice a year, in February and August. And that includes mid-project increases by each craft. So craft thinking carpenter, electrician, et cetera. Whereas Davis-Bacon, it just has to be in the bid specifications. Doesn't matter if it changes, as long as the original contract specified a certain wage determination, then that's what goes. Some states issue it on a project-by-project basis. Maryland issues it once a year by county on a rotating basis. So it really varies. But again, look to the bid as well as that geography.
Nat, is it worth maybe briefly mentioning the conformance process? So I do see this with technology advancing so quickly. I do see this becoming more of an issue. We'll talk about it later. The rulemaking that the DOL is proposing addresses some of this and makes conformance a little easier, believe it or not. But the conformance process is one that I do see folks struggling more with because the needs on jobs have been changing.
Absolutely. And I think, similar to how it must be in the contractor bid specifications, it's important to work with that contracting officer. There's always a contracting officer if something isn't in the bid. And for instance, in my earlier example, there isn't a laborer in a specific bid. It's important to file a conformance and speak with that contracting officer to understand that need. We had a solar electrical contractor, for instance, in California. They were installing solar panels, but they wanted to employ laborers to unbox the solar panels, not to do anything with them other than take them out of boxes. But because that wasn't in the bid specification, they couldn't do that without, to Adam's point, filing for a conformance to allow a laborer to literally just unbox the solar panels. So excellent point. Sorry. So specific state-by-state compliance, another thing to keep in mind is that the rate lock and the extension of that. And so, federal Davis-Bacon, as long as it's awarded within 90 days, that bid can be firm. Again, California allows mid-project wage increases. Different states have, or locales have different requirements around overtime, 8 hours per day versus 4 10-hour days and those types of things. So That's one of the reasons why these bid specifications can be quite lengthy, is they'll typically specify all of these things. So many of you are familiar with certified payroll. Basically, what the certified payroll is doing is tracking the specific job occupation, the specific person, what was that minimum wage, what was that minimum benefit amount, and how did that contractor comply with that. At the federal level, it's called the WH-347. Various states have their own certified payrolls. Many people are moving toward the electronic delivery of certified payroll. There are different systems that do that, whether it's payroll for construction or LCP tracker. There are audit systems like EMARS. The important point here, shown in blue, is that it is not just the certified payroll that's required. It's also detailed documentation supporting where those funds have been spent. So for instance, if you have an approved apprenticeship program and you have apprentices in that program, you not only need proof of those contributions, but the apprenticeship forms and so forth, showing who actually attended those, who was an apprenticeship, and those types of supporting documents. So some of you may have seen this before. This is the paper version of the federal WH-347. And I know it's very small there on the screen. My reason in showing this is that there's a little box, just kind of the bottom left corner. And that box is where it talks about fringe benefits. And a lot of people aren't clear of, well, how difficult is it to provide fringe benefits? And so some of what we're going to spend time on today is that the difficulty and work has really largely already been done by the contractor, meaning the difficult administration is around who was on what job, at what prevailing wage rate, at what prevailing fringe rate, and how much is owed to that individual employee when they're working on multiple jobs, some private, some public, different public jobs, different fringe rates, and so forth. But once a contractor decides to contribute some or all of those fringe obligations to a benefit plan, they're literally checking a box. And so
Nat, I'll throw in there or echo something you said earlier about the payroll firms that are out there. So often over the last many years, I've talked to contractors who struggle with certified payroll at the federal and state level because they're not using the right tools, right? And yeah, I'm using that word intentionally. It's to a point now where there's technology out there that makes this process so darn simple. And so if you're not working with a payroll provider that has automated certified payroll reports built into their system, stop banging your head against the wall, right? There are several awesome systems out there that are built for contractors and have all of this automated. Payroll for construction is the one you mentioned, that, but I know there's many more, but it's a question to make sure you ask when you're looking at the payroll solution you're using now or one you're thinking about using. Get that infrastructure in place that makes this whole process a lot easier. And those firms then, their job is to keep up with the appropriate form at each state level. All right, so this looks like a really simple slide, right? A plus B equals C. What you're looking at is a very simple wage determination. Base wage of $30 an hour plus a fringe benefit amount of $10 an hour for a total hourly wage of $40 an hour. Now, there's a lot behind these numbers. And so I'm going to talk about, for a few minutes here, what are some of the things to make sure that you're thinking about. And some of these things have real impact on your competitiveness within the bid process, has a lot to do with your ability to set up benefits that can help you attract and retain workers, especially in the tightest labor market since, I think it's World War II. But also, there's a lot that can be achieved here through increasing profits by having a solid knowledge of how you execute, if you will, or how you pay the required wage. So first and foremost, that $10 an hour fringe benefit amount is for the employer to decide how to pay. The reason I mention that is so many contractors over the years have said to me these words, well, that's the employee's money. That's the employee's money. I hear that a lot. And so change that thought process going forward and lock it in your head that this is an employer decision to make in terms of how to spend that $10. And if it's put towards a benefit program, it's an employer contribution to that benefit program, not an employee contribution. So that's the first thing I ask people to sort of set in their mind, that this is your decision to make. You're in control of that $10 and deciding how to spend it. It's not all or nothing. If you could go back, Nat, I'm sorry.
Mm-hmm.
I think someone, okay. It's not all or nothing. So it's not that I have to put either all $10 on the paycheck or all $10 towards fringe benefits. I can divide up the number. So I can take $5 and pay a $35 base wage and put $5 towards fringe benefits. So I can break up that $10, 3 and 7, 5 and 5, 6 and 4, however I decide to do it based on what I'm trying to accomplish with benefits. There is the ability to dip into the base wage. So if I wanted to pay $28 in base wage and $12 towards fringe benefits, I can do that, except for a few states. For example, I believe California is a sacred base, if you will, state where you have to pay exactly what the base wage is. You can't dip into it. But for reasons we'll point out in just a minute, to the extent you can dip into the base wage and pay a lower wage, hourly base wage, you can make yourself more competitive or free up some profits. And we'll show you more about that in a few slides here. In some states, I believe Nevada, what's that? No, not yet. In some states, like in Nevada, it's a one-rate state. And what that means is you won't see a breakdown. You'll see one hourly wage in some wage determinations. And what you need to know is just because it's one number doesn't mean you can't break it apart, that you can't break that $40 into 20 and 20 or 30 and 10, whatever the case may be. So keep that in mind. Another note is apprentices. In most cases, apprentices are paid about half the base wage and half the fringe benefit amount. And so what I would suggest to you is look at the ratio of journeymen to apprentices that you're allowed on a contract and optimize the use of apprentices, because obviously you can pay a lower wage to them than what you pay the journeyman. So optimize that ratio. Some contractors take the approach of matching the base wage for their private work with their public work. So if the rate on the private work is $24, then they'll take that base wage down to $24 and put the other $6 into fringe benefits to match the wage. Now, the difference is that the employees on the public job are going to have a fairly rich benefit program, probably in the form of a retirement contribution. But sometimes that can take away the difficulty in moving people between jobs because the favored people get to go on the more expensive or higher paying jobs, I should say. This is a really tough decision now in terms of how much to pay in wages versus benefits. You know, with the labor market being so tight, the last thing you want to do is take a whole bunch of money off their paycheck and put it towards benefits. That can be really tough to do. That being said, these days I'm seeing more and more workers identifying with the need to have benefits in place. And so striking what I would call the right balance between what you put on the paycheck and what you put towards benefits is really important from attracting and retaining solid workers. So you got to balance that with the savings that you can generate based on the more you take off the paycheck and not pay your payroll burden on. So the main message here is the more you can get, and we'll show this in a minute, the more you can get off the paycheck and into benefits, the more money you can free up for your business. And we'll talk about that in real numbers here in a couple of slides. So sorry, Nat, that's my last point on that slide that looks simple, but there's a lot to it.
Oh, that's excellent. So Adam mentioned that you can do cash, you can do benefits, or any combination thereof, literally any. And it is entirely up to the employer. So if an employer decides to pay those fringe obligations in cash, that is legal. However, it is costly. And here's why it's costly. It's costly because every dollar that is put into the paycheck for, by the way, all of us, for every single person in this country and every single firm, not specific to prevailing wage or construction, that dollar in the payroll is now subject to what I like to call payroll burden. So your payroll burden is made up of 5 components typically. There are some exceptions, and I'll talk about those. But FICA, that's another name for Social Security. That's 7.65% that the employer pays for every single dollar that goes into every single employee's paycheck nationwide. Then you have federal unemployment, and federal unemployment is kind of a complicated formula, but that typically works out to 0.5% or so. Then you have state unemployment. State unemployment likewise varies dramatically. So it might be as low as 2%, might be as high as 6%. General liability might be another couple percent. And in most states, Washington is the exception, for instance, but in most states, workers' comp is built on that payroll. So as an employer increases the amount of payroll, they're paying all of these taxes and insurance premiums on those wages. And so, another way to look at that is that it's not just equivalent if an employer pays fringes on the paycheck or pays fringes into employee benefits. They're not the same. Let's look at a specific example here of a laborer. So in this specific example, I've got a laborer, base wage of $30, fringe of $10, just like the previous slide, gives me a total wage of $40. That payroll burden I was mentioning, FICA, FUTA, SUTA, general liability, workers' comp, that's 25%, typically back of the napkin. 25% of $40 is $10. I add it all up, that gives me $50. By contrast, if as an employer, I pay $30 as the base wage and that's it, now my payroll burden is only $7.50, 25% of $30. Now, I still by law have to make that contribution. I'm just not putting it into payroll. I'm now putting it into a pre-tax bona fide benefit, and we're going to spend some time on this. So that $10 just costs $10. And by the way, this is the way the unions do it. If you were a union contractor, it would look like the right-hand side. You would pay the base wage, you would pay payroll burden on that base wage, then you would send $10 off to the union. By doing it the way that it's shown on the right-hand column, you get to a total bid cost of $47.50. That's $2.50 per hour of labor and 5% lower on your bid cost. That's significant, where labor costs are typically your first and most expensive line item on a budget. So let's also look at this in aggregate. So in this savings example, I've got 15% of a contractor's work is government work. Now, we know contractors don't typically work an exact 40 hours a week, 52 weeks a year, but let's use 2,080 hours as just a simple math starting point. So 2,080 hours, 15%, 312 hours. They're 25 hourly employees. The savings that we just mentioned by removing those fringe obligations from payroll and moving them to a pre-tax basis, that was $2.50. So the multiplication is 312 hours times 25 employees times $2.50 per hour gives me a savings in this specific example of $19,500. So even though this contractor isn't a super large contractor, they only have 25 employees, and even though they're not doing a tremendous amount of prevailing wage, only 15%, And even though these are just relatively medium wage laborers, not super expensive payroll, I'm saving a pretty significant amount of money as an employer.
So Nat, I'll throw in a couple of comments on that last slide. The situations I see that are the sort of most concerning, and when I see the sort of blood leave a contractor's face when they make this realization, is that when they're paying the entire fringe as wages, and then they're also paying for the healthcare and dental and vision and all those types of things on top. And so at that point, in this case, that 19,000 is going to go way up, way up, because you're ostensibly double paying. So, if you're going to pay for benefits, at least use that fringe towards what you're going to provide, because otherwise you're paying it twice.
Absolutely. Well said.
And then I would also add that the 15% in this example, given what I see going forward with the infrastructure bill passed last year and $500 billion getting smoothed out across the country for infrastructure projects, I would imagine that many contractors who have been doing public works are going to be doing a higher percentage going forward.
Exactly. There's tremendous opportunity to do more of this work. And so someone was asking in the chat, and I'm going to cover a couple of questions here that have been going on, and continue please to ask those questions in the chat. But what are fringe benefits? What are some examples? So there are typically 4 categories of where, at least at the federal level, and most states and localities follow the federal. Again, there can be minor exceptions, but mostly there are 4 categories of where those fringe obligations may be spent legally, other than cash. Obviously, cash is legal as well. But other than cash, you can do training. And to be very clear, what I'm referring to is apprenticeship training done by an authorized apprenticeship program. So for instance, if you do a toolbox talk on safety, you cannot deduct fringes for the cost of having someone come out and do a toolbox talk. That is not training per the Davis-Bacon Act. It's only for apprenticeship programs. And so if you have a journeyman electrician, for instance, that journeyman electrician is not eligible to have his or her fringe dollars deducted for training. Second is PTO.
Maybe put a plug in. I was saying, can you put a plug in there for ABC?
Oh, I apologize. I meant to. Sometimes we work so closely together that I forget. But ABC is the leading provider of apprenticeship programs for non-union contractors. So 69 chapters all around the country, and the vast majority of those chapters have 1 or more apprenticeship programs. So not every chapter has every program. So you might be an electrical contractor here in Austin, Texas. Well, the Austin, Texas, Central Texas chapter doesn't have an approved electrical apprenticeship program. So you couldn't use that for that contractor. But there are other apprenticeship programs. And so again, that's only where it's applicable, but ABC is certainly a tremendous provider of that education. Next category is vacation. Called it vacation here. Want to be clear, what we're talking about is also known as paid time off, also known as sick leave. You can call it different things, but the bottom line is you can use fringe dollars to set aside money for those types of programs, PTO, sick leave, vacation, et cetera. Generally speaking, those don't use a lot of the fringe up. And so, we can get into the details offline, but bottom line, you're not talking about very much money, maybe a dime or a quarter per hour. And so typically you've got a lot more money to spend. And so then the 2 other bigger buckets which are always applicable. Again, dealing with just Davis-Bacon, retirement and health and welfare. So one of the questions earlier was, in retirement, can I use fringe dollars for only the employer match, or can I make retirement contributions outside of that employer match? And it's a really interesting question because many construction workers do not electively defer into a retirement program. So if you tie that fringe contribution to that worker's elective deferral, you may not get much participation. You may not have people that are deferring, and therefore your match is worthless, because if they're not deferring, there is no match. And so know that that employer can make bona fide fringe contributions at an employer level without the employee's permission and without it being tied to the match. And in fact, you can do a lot of other things with fringes and retirement programs. You can use those fringe contributions to help employers meet testing requirements, for instance. So retirement plans, because they're tax advantaged plans, the government doesn't want all of the tax advantages to go to owners and highly compensated employees. And so if nobody's participating in the retirement program, then owners and executives can't participate in the retirement program. And so you can use those fringe contributions to help owners and HCs make their own contributions to the retirement plan. Another example is you can use those fringe obligations made to those employees participating in a profit sharing plan. And so let's just pretend, for instance, that you had a 10% profit sharing contribution across all of your employees. Well, if you've already met that 10% threshold with your fringe obligations, you actually don't owe more than that. You can certainly pay more than that if you want to, but you don't have to. And to Adam's point earlier, we see this very frequently in the health and welfare side, where an employer is paying for health insurance, for dental insurance, for disability insurance, for various services and products, and also taking all of their fringe obligations and paying them in cash. Well, that is literally double paying. The fringe is intended to pay for things like retirement plans and health and welfare plans. And so deducting the cost of those plans is something that we're going to talk a little bit more about here. Anything you'd add to that, Adam?
No, that's great. There's a number of questions I can see coming up around how to establish programs for time off, for example. And so I think that'll be best covered on the next slide when we talk about the bona fide benefit rules. And we can also touch on the difference between unfunded and funded health plans and how important that differential is.
Excellent. Yeah, so bona fide is just a fancy way of saying legitimate. The government has stipulated certain requirements that make a fringe benefit plan legitimate. First and foremost, it must be specified in writing and covered and communicated, to the covered employees. So you couldn't just behind the scenes take everyone's fringes and not tell them what you're doing about it. No, you have to document it and you have to communicate that to the employees. Employees, we're taking your fringe dollars and we're using $5 per hour of every hour worked to implement a Blue Cross and Blue Shield health plan. And here's the plan summary and the plan documents that is written and communicated to those covered employees. There must be irrevocable contributions, and those contributions must be made to a third party or trust. So an example of that is dollars flowing from an employer to an insurance carrier, in my earlier example, Blue Cross. And there's no way for those dollars to come back. So there are various plans out there, self-funded, Adam mentioned. You can't do fringes going into a self-funded plan because that hasn't left the employer's books. It's still self-funded by that employer. What you can do, and this is a little bit outside of the scope of this discussion, we can talk more offline, but what you can do is create a trust, make those contributions into that trust, and then have a self-funded plan within that trust. But the bottom line is that that contribution must leave the bank account of the employer, go into a trust or third party for that full amount of that employee's fringe obligation, and that must be done within 90 days in most cases. There are exceptions. Hawaii, for instance, is within 30 days. It must be a benefit to the person actually performing the work.
Hey Nat, can I go back on that bullet really quick?
Sure.
I mean, this, of all the bullets on this page, this is one of the most important ones, the irrevocable contribution to a third party or trust. And it helps to answer some of the questions we're seeing in the chat. So Nat covered clearly what irrevocable means. It cannot come back to the general assets of the company, right? Once it's provided for benefits, it's got to stay there for the benefit of the employee. Like Nat said, a third party can be the carrier. But for many of these programs, a trust could come into play. So for example, there was a question about PTO and sick time. So think about that in terms of these rules. You've got any money you're going to set aside, any fringe, I should say, you're going to put aside for PTO or sick time has to be provided to a third party or trust within 90 days. So Nat used the word earlier, a set aside. So you would need to set aside those fringe contributions that are earmarked for time off in a separate account that cannot come back to the employer. Same with an HRA, for example. If you're going to set up a health reimbursement arrangement, it needs to be a funded HRA program, not your typical, the employer pays the reimbursement when it occurs, because then you've got the fringe setting in your general assets. So if you're going to do an HRA, you've got to contribute the contributions to that HRA within 90 days. As Nat said with the self-funded plan, similar idea, the contributions to the self-funded plan need to go into a separate trust. You can't pay the claims out of your general assets as they come unless you have a separate approval from the Department of Labor, which you can attain, but it is difficult to come by and you got to go through a lot of paperwork. So it's not to say you can't do it, it's just a challenge, right? So a lot of contractors opt in a self-funded arrangement to go level funded or to go with a self-funded program where they're funding, as Nat said, a third party or trust, and they pay their claims out of it. So I know there was a mouthful there, but I just wanted to kind of wrap this all together because that bullet there wraps into so many things. The apprenticeship training program is different because there's actually an amount per hour you're submitting off to the apprenticeship trust, and it's separated from you then within 90 days. Hope that helped, Nat.
Excellent. Yes. Group benefit plan, in most cases, it's required that it be a group benefit plan as opposed to individual benefits. There are some exceptions to that. To Adam's point, that the third bullet is really, the second bullet is really the important one, that irrevocable. Accounted for on an hourly basis, so we already mentioned on that certified payroll. And then except for automatic vesting retirement plans, meaning a plan that essentially has immediate vesting. The DOL defines that as vested within 500 hours. And so with the exception of automatic vesting retirement plans, contributions must be made for all hours worked, not just those worked on public construction projects. So this is what the Department of Labor calls annualization. An annualization is the Wage and Hour Department's interpretation of legislative intent. So it's not actually in the code or in the law. It's just the department trying to be what they consider fair. And we're going to explain what their thought process is. But essentially, that is from a high level, it's this idea that Congress did not intend for contractors to use fringe obligations to subsidize benefits that are available throughout the year. So for instance, health insurance, by contributions that are made on prevailing wage projects. So I highlighted a couple of bullet points here. The key points are benefits that are continuous in nature. So life insurance, as an example, is by definition continuous in nature. I want it all of the time. There isn't a time, well, yes, I want life insurance today, but I don't want it tomorrow because I know I'm not going to die tomorrow. No, I want it all of the time because I don't know when I'm going to die. So it's continuous. Again, prevailing wage retirement plans, those that have that immediate vesting with irrevocable contributions are specifically exempted. And key takeaway, government work cannot be used to fund benefits accrued while working on private work. So here's kind of a, for instance, an example. I've got an employer, and that employer provides health insurance for $500 per employee per month, okay? So $500 times 12, annual cost $6,000. I've got an employee, and she works 500 hours on prevailing wage jobs. $38 base wage, by the way, that's a little bit irrelevant here, but just giving you a for instance. $12 fringe, that's important. 500 hours times 12, that gives me a total fringe obligation of $6,000. Well, some people would look at that and be like, well, I have $6,000 and I have a cost of $6,000. So I can use my fringes to pay for health insurance for the whole year. Cannot do that. That is incorrect. What you have to do is understand the total number of hours in the year, meaning the hours that were worked on private jobs, in this case, 1,500. So I need to divide that $6,000 of annual fringe obligation by the total of 2,000 annual hours of labor to give me an amount of what's called taking credit of $3 per hour of that labor. So when that employee is on that job that's paying that $12, they're going to take $3 of credit for health and $9 per hour must be discharged into something else, either on the paycheck or other bona fide benefits. Important to note here that that $3 per hour, that employer is coming out of pocket, meaning paying without any fringe obligation that 1,500 hours on private jobs. So that's $3 per hour for that health for all 2,000 hours. I know this is a complicated subject, so if there are additional questions, we can get into them, or feel free to contact me offline. But the key point here is that you need to develop a per hour cost for health insurance and other insured benefits, life insurance, disability insurance, dental, vision, those types of benefits. Those are all of the time. I don't know when I'm going to get disabled. I don't know when I'm going to lose my life. I don't know when I'm going to break my arm and need health insurance. And so because they're continuous, I have to annualize, meaning come up with a per hour amount and essentially pay that amount for every single hour, whether there's a fringe of $3, of $5, of $15, of $30. I have to pay, or no fringe. As an employer, I have to pay that all of the time.
You know, a simple way I keep it in my head, and that is, you know, using the example earlier of the $10 fringe amount. Let's say my major medical, dental, vision, and life, you know, disability, all of that comes up to $4 an hour, right? I know that I've got to pay that $4 for every hour that my worker works, whether it's on private or public jobs. And then there's $6 left. And as Nat said, you could pay that on the paycheck. But what's nice about the retirement plan option is that because of that exemption from annualization, I only have to pay that $6 on the hours the employee worked on public projects. So I'm not coming out of pocket for that $6 an hour on private jobs. It's only where I have the fringe money coming in from the contract to pay for it. So that's where annualization can be powerful for the retirement plan side, because it gives you that flexibility to absorb, in many cases, the rest of the fringe over and above what you spend on health. And you don't have to pay it on every hour worked, just on the hours worked on the public project. So that's the simple way I keep it in my mind, Nat.
Yeah, no, I think that's excellent. And one of the participants mentioned, can the employer use the portion of the amount that they cover of health toward the fringe? Again, all of this is employer dollars. The fringe contribution, that is an employer obligation. Those are employer dollars. And so when we're talking about $3 of credit of health, that's an employer dollar amount, and that has nothing to do with the payroll deduction or employee contribution toward the plan. This is only for the employer portion. The way we generally set up plans, and you can do it different ways, is what is the employee only cost? And I'm going to set that up based on a certain cost. In Adam's example, $4 or $3 or $5, whatever that amount is. And I'm, as an employer, going to pay that $3 or $4 or $5 every single hour for every single employee, irrespective. Again, that has nothing to do with someone adding their family to their dental coverage. That would all be payroll deducted. That has nothing to do with annualization. That has nothing even to do with employer dollars. That's employee money as opposed to employer money. Okay, so moving on to retirement plans. Prevailing wage compliant plans permit employers to determine how much to contribute on an hourly basis based on their job classification, job class, or site. And so a couple of examples here. So if I have a job site that, because of various parameters, geography, job class, those types of things, has very, very high fringes, I might take more of those fringe dollars and put them into a retirement plan, or fewer of those dollars. And maybe it's a really small fringe in a low fringe state. Maybe it's only $5, and I'm going to give all $5 to the employee in cash. But when I've got a $30 fringe, then I'm taking $25 and putting it toward a retirement plan. So you can vary that by job classification or by job site. It does not have to be the same thing for everyone all hours. Remember, it's exempt from annualization. You can actually set it up so that, in fact, your contributions are only on prevailing wage jobs. So in a simple example, no matter what the fringe obligation is, 100% of the fringes are going to go into the retirement plan. On this particular job, it's a $5 fringe. That $5 flows to the retirement plan. On this other job, it's a $30 fringe. That $30 flows into the retirement plan. So you can set it up how you'd like to, but it's important to know that you can vary that by job classification or job site. So another example of job classification is, in some cases, you might have, say, a supervisor, and that supervisor makes sure the trains run on time, is a really long tenured, loyal employee, and you're worried that that supervisor might quit if he or she doesn't continue to get fringes in cash. And so you could class out supervisors and say supervisors get fringe obligations in cash on the paycheck. And I know that I'm paying that payroll burden. I know that that's costing me extra, but for the supervisor, it's worth it. And for everyone else, for electricians and apprentices and so forth, for all of those other people, I'm going to provide a retirement plan. I'm going to provide health and take credit from it and use those fringe obligations for what they were intended to do. So you could differentiate between tenure. You could say people that have been with me more than 5 years, 50% of their fringes are going into cash, 50% into a retirement plan. So that's what I mean by job class or job site. We've mentioned this a couple times, but it bears repeating. These are employer contributions. So just as employers get to decide lots of things, like where employees work and which truck they drive and which job site they go to and all kinds of other employer decisions, These are employer decisions. These are employer contributions. Very, very different than elective deferrals, very different than an employee choice. They must be 100% vested. Just know that plans can be set up in a variety of ways. You can have plans that are for standalone fringes only. You can have plans that have elective deferrals and fringes. You can have a profit sharing plan, as I mentioned earlier, where you reduce the profit sharing owed to a prevailing wage worker by the amount that was contributed for fringe obligations. And so all of these things can be done to help leverage and maximize owner contributions into a retirement plan, meaning lower profit sharing plan obligations and increased, or what we call boosting, the owner's ability to contribute to their own plan and still meet HCE testing.
Nat, I would just add that this is a critical time when you are in such a tight labor market and trying to get talent on board or keep the talent you have, to look deeply into how you can design your retirement plan to take full advantage or unlock the plan's potential when you flow the fringe dollars into it. If you want to provide some profit sharing across all of your employees, I've seen some contractors pay a 10% profit sharing contribution to their retirement plan. They pay it for everybody, but don't realize that the contributions they made in the way of fringe to the plan can be offset. So they're double paying, right? So A, don't double pay. B, use the profit sharing to attract and retain workers, and use the amount you've already contributed in the way of fringe dollars to offset the total expense of the profit sharing. And like Nat said, if you want to attract highly compensated individuals, don't have them be frustrated with getting refunds from the plan because your employees aren't contributing themselves. The fringe contribution to the plan can be counted as the employee's deferral. So take advantage of that. Anyway, I think, Nat, it's just worth mentioning that in today's tight labor market, it's worth taking a deeper look on how to design your retirement plan. And if you're working on public projects, use those fringe contributions to unlock further potential within that plan for other people in your business.
Absolutely, absolutely. Yeah, I mean, I would just add that I think some people sometimes trip over pennies and miss the dollar. And what I mean by that is they say, well, my guys really like getting the fringe in the paycheck. And then I ask them, how much prevailing wage do they do? And they say, well, we only do about 5%. And the reason they're only doing 5% or 10%, a very small percentage, is because they're not winning the bids. And then I say, wouldn't your employees rather get more prevailing wage work where they have this higher prevailing wage base wage, where they have this higher prevailing wage fringe allotment, and you get more money, they get more money. And yes, some of those fringes or all of those fringes are going into bona fide benefits, but everybody comes out ahead because there's more work for the employer, there's more work for the employee, that employee's getting a bigger base wage without even dipping into it. And everybody really comes out ahead. So I think you said it well, Adam. So, just looking at this from and kind of tying some of these things, these concepts together, what as an employer are my advantages to offering bona fide benefits? And first and foremost, it's competitive bids or higher profits. I tend to find it's one or the other. Either it's, as I was just saying, they're only doing a small amount of prevailing wage because they're not winning those bids. And so if you put in place a plan, then the company wins more prevailing wage work. Those employees do more prevailing wage work with those higher base wages, with those higher fringe allocations. If the employer is already winning plenty of prevailing wage work, well, then this is just profitability. Then it drops to the bottom line. And then it's how do you utilize those savings to make contributions, kind of skipping to bullet 4, but maybe make contributions to an owner or other highly compensated employees, implement a profit sharing program, and how to best spend those. It's also going to free up cash flow. So under the Davis-Bacon Act, the employer has 90 days to pay for those bona fide benefits. If that fringe obligation is paid into the paycheck, however, that has to be paid in weekly. And so there's quite a differential between, as an employer, I need to come out of pocket this week for my fringe obligations, versus as an employer, I can come out of pocket in 60 days to pay for those fringe obligations. If it's 60 days, I might have already been reimbursed for that work. Now I don't have that float issue of I'm paying out money that I haven't received yet as an employer. And so it can free up cash flow. As Adam mentioned, it can also help equalize wages between public and private work. And so, if you're in a geography or a occupation that has fairly high base wages, and your private work is well compensated, and you don't need extra public base wages, dip into that base wage to even though. Even if you don't do that, even if in a hypothetical example, private work is typically $50 and public work might be $60 per hour base wage, you're going to narrow that differential by taking, say, $10 or $20 of fringe obligations and taking them off of the paycheck. Now the employee doesn't really feel that and want to use that and spend that money immediately because it's not actually in the paycheck per se. There's a reason every single one of the Fortune 1000 companies offer benefits. Why? Because people want them. They want health insurance. They want retirement plans. And it really goes to an employee retention. It goes to, well, why am I working for a firm that doesn't offer benefits when I could go work for the union? And so retaining that non-union labor is critical to offering a roughly equivalent, or in many cases better, retirement plan. The unions might have all kinds of caveats about what waiting periods and vesting periods and all these other things that would not apply to the non-union side of things. One of the biggest concerns I hear initially is, well, this is going to be really hard to administer. Benefits are really hard to administer. And actually, it's not. They're really, really simple to administer. And to Adam's point earlier, if you're not working with a good payroll provider that can automate this and keep track of all of this, then you probably want to look into that because it does not have to be a real pain in the neck.
Yeah, I would say, Nat, there's, getting the infrastructure right and your partners in place makes this easier, right? So the payroll is where it all starts. Right? So get that squared away. You're going to need a great third-party administrator of some kind to help you with the math and submitting all the appropriate contributions and getting the carriers paid timely and all that. You'll probably need an organization that can help you with the single employer trusts you might need for things like time off. And if you're going to do a self-funded plan, you're going to want to look into apprenticeship training opportunities, right? That's another thing you can spend fringe on. You'll want to work with carriers that can structure their policies to accommodate the hourly workforce that you have. And if not part of your TPA, then you're probably going to want a consultant or somebody who you can go to with tricky questions, because in many cases, it's not a great idea to submit your questions directly to the Department of Labor. So have somebody who can submit those questions on your behalf, either to the federal or state level. So those are just some of the parties that you might kind of pull together to team up for you. And by the way, some of that fringe can be used to pay the fees for these various parties. But obviously ERISA kicks in and these fees need to be reasonable. They need to be disclosed. But that fringe money can be used to cover or help defray the cost of a lot of these programs I just mentioned.
Yes. So someone had earlier mentioned, how come employees have to pay so much more for their insurance if employers are using fringe money to pay for the health insurance? And I think I understand this question. And essentially it's saying, well, if I've got two employees and one of them has fringes and one doesn't, and I'm deducting the fringes from the first employee, isn't that unfair? And here's why that's not the case. Because we're talking about employer contributions. So in both cases, the employer would agree to say, for every hour you work, I, as the employer, am going to pay $3 toward your employee benefits. And so both employees, even if the employee does no prevailing wage work, is getting a $3 contribution from the employer. It's important to remember that the employee that's working on the prevailing wage work, that's a minimum. So, but again, that's an employer dollar. By spending the same $3 across both employees, that employer is now compliant with that. They're now meeting those minimums. Here's another, maybe for instance, example. In many states, right to work, especially southeastern states, there isn't very much of a union presence, and the minimums that are required are actually below what employers already do. So if an employer already pays $50 an hour base wage and gives $3 per hour in health insurance, and the Davis-Bacon requirements are $40 an hour in base wage and $2 in benefits, well, that employer's already met that obligation. So I just wanted to clarify that for that person who was asking about that. And I've been asked that many times before, and so I thought it was important to bring up.
So now, before we jump off the employer slide, just a couple of additional tools to mention. There is something out there called hour banking. At the ABC Insurance Trust, we call it dollar banking. You know, one of the things that's a struggle for contractors, or can be, is that everything in the benefits world is monthly, and so much of your lives deal in the hourly basis, if you will. So hour banking can break that monthly premium down into an hourly rate. At that point, it's very simple to multiply the hours worked times the hourly rate and submit your contribution to the Hour Bank Trust. And then in busy times, you can bank up extra hours, use those hours in down periods or in the winter to help keep your employees on benefit. It also assures you don't overpay premium because you're paying the exact amount per hour that the employee is entitled to. It helps with the reporting for certified payroll, of course, and gives you a nice audit trail that you have paid the exact amount per hour towards their health and welfare benefits. Another tool that's out there is a composite rate service plan. Many of you struggle with doing the math for age bands, where every employee and every dependent has a different rate. There are programs out there that will allow you to collapse all those age bands into 4 tiers, and you remit the 4 tiers to the trust, and the trust pays the carrier the age bands. And so there are some simplification tools that you can tap into to make the monthly math, if you will, simpler for you and your business, and also give some additional benefit for your workers, especially if you have a lot of fluctuation in hours or seasonality in your work.
Excellent. So we have one last slide here, and then we'll try to get to some of the questions that we might have overlooked. But I think it's important to understand that we are somewhere 600,000 laborers short, skilled laborers short in the United States. So if we're implementing something that employees don't like, they can easily go somewhere else. It's an employee labor market. And so how this is rolled out is critical. And if employees just kind of get a memo and don't understand why you're doing this as an employer, then that's not really very helpful. Explaining to them what their advantages are, what's in it for me, what's in it for the employee, Well, first and foremost, it's because we want to win more of this prevailing wage work. We need to do it the way the unions are doing it. We need to lower our costs on taxes and insurance premiums to be more competitive. These fringes were designed for benefits. I mean, if Congress just wanted a higher base wage, that would have been a whole lot easier. But they specifically separated out fringe benefits and created lots of rules and regulations and specific amounts and so on because it believed benefits were important. In most cases, the base wage for prevailing wage is already higher than private work, even when fringes are used for benefits. So, Davis-Bacon allows you to dip into that base wage. Most states do not allow you to do that. I think there was a question by someone about Hawaii. Hawaii does not allow you to do that, I don't believe. But even so, by that employee is going to get a higher base wage plus these tax deferred benefits. And remember, these benefits are 100% vested from day one. So this is the employee's money. They own this money. And last but not least, if the employer permits loans to be taken against their retirement plan, employees can borrow against their retirement plan. And so you put all of these things together and you create an enrollment strategy that treats your employees as partners, as colleagues, as having a vested interest in the success of the firm, in competing against union benefits and unions, and says, look, we want to invest in you. We want you to have benefits. And I still practically tear up when I happened to be present and an employee walked in unannounced and told the employer in front of me with tears in that employee's eyes, I am just so thankful that you put this plan in place. For the first time in my life, I have $10,000 in an account. I've never seen that before. And so if we start to look at this as this is good for the employees, this is what they need, this is what the law was intended to do, I think employers come out ahead.
I guess it's question time, Nat. And I guess there's a lot in the chat and there's a lot in the
in the queue.
In the queue, yeah. So we've got just a couple of minutes.
So thank you to Daryl for correcting me on Colorado now having a prevailing wage at the state level. I had missed that. So thank you. I will look into that. No one can know all of this. It's constantly changing. And as you may know, the DOL at the federal level has requested comments on tremendous, over 150 pages of potential changes. So the good news is we're constantly looking at different things. We're seeing, so a question was about substantial IRS subsidies or credits. A lot of big projects are getting pulled into prevailing wage, and not only pulled into prevailing wage, they're getting pulled into PLAs or project labor agreements, which are basically union mandates. And so it's where even a merit shop non-union contractor has to follow the union guidelines for contributions into the union program, even if that employee isn't really eligible to get benefits from that union program. So it can be very anti-merit shop, but that's very much happening in many of the so-called blue states or Democrat-led states. I'm going to skip questions that I honestly don't know the answer to. I can look into them. If you want to contact me or Adam offline, we can look into them and find out.
Let's say the ESOP question was asked a number of times. I think the big concern I would have there is around annualization. You may be able to take credit for contribution there, but are you prepared to make that contribution for all hours worked? Because I don't know that there's an exemption from annualization on an ESOP.
I don't I don't even know that you can make contributions into an ESOP. I will take that away and look into it, but
Is it bona
you
fide enough?
typically, the answer is typically no. I'm not certain of why. It may be annualization. It may be that it's actually prohibited, but I don't.
Someone else brought up the point too that, generally the contribution is made annually or on a less frequent basis than the fringe is required to be contributed. So that's going to be a challenge as well.
Exactly. So a couple questions around payroll solutions, specifically payroll for construction. Does that help with their certified payroll reporting? Yes. So those systems are already tied in to the various states and localities, and certainly the federal government, for providing those reports electronically, making sure it's in the right format, because every different jurisdiction, California versus Hawaii versus the federal government, has a different format and a different place to submit those reports. And so that's one of their big value adds. Payroll for construction, just as a specific example, does upload directly to LCB Tracker, does upload directly to EMARS, and those various certified payroll reporting sites. Are safe harbor contributions to 401k? Yes, you can submit a safe harbor, and you can use fringes for that.
Yes.
I don't know how easy it would be to create a list of states that don't allow you to dip into the base wage, but I would look in your own particular state. Most states do not allow you to dip into the base wage, including Hawaii. Does not allow you to do that. Can you walk through how the prevailing wage on a DBA job is calculated? So by the way, we're running over in time. I'm willing to keep going, but this will be recorded. If you need to drop off, you're certainly welcome to. So basically, the way the federal wage surveys are created is literally wage surveys. So they go out to contractors. Many merit shop contractors don't bother to fill out the surveys. They can be kind of a pain in the neck and detailed to fill out. The unions, part of why you get such a discrepancy in private market versus union wages is that the unions fill out the surveys and in fact are motivated to inflate those surveys because those dollars flow to the union. And so that can be a real issue around that. But yes, it's survey led, and that's how they create that, is how many people in which job and what was the amount that you paid and so on and so forth.
So I think we need to probably wrap it up, Nat. I think also what we can do is attempt to cull these questions that we didn't get to and see if we can put together a document to provide to Sue to help out.
Absolutely. Yeah, one of the other questions was when you say irrevocable contributions made to a third party or trust, what do you mean by a third party? Does a health broker count? No, a health broker would not count. An insurance carrier would count. An employee benefit trust would count. Those types of things are, the key amount is that it's leaving the employer's balance sheet, but it can't go to just any intermediary. It has to be kind of a bona fide intermediary that's actually providing the benefits. And most brokers wouldn't take money anyway. So, but yeah, I think we covered a lot of it.
Mm-hmm. All right. Thanks, Adam and Nat, for presenting with us today. There were so many questions asked. You guys did a fantastic job. And we have a list of all the questions. We're going to try to provide answers and get those out to everyone. We can do that. Everyone, don't forget to fill out those evaluations after today's session. We do appreciate your comments and feedback. I just wanted to mention later this month, we're going to be offering our very popular Basics of Construction Accounting course. If it's not for you, perhaps someone on your staff could take advantage of it. And I also wanted to mention our CFMA conference is coming up May 14th in Atlanta, Georgia. You can find out more information about that on our website at conferences.cfma.org. Thanks again, everyone, and have a great rest of your day.